Well, good morning, everyone. My name is Brendan Derone. Today is June 8th, and we have Jason Jafferis on from Prudential for our BREW. But before we get to him, of course, we've got our national days. It is National Best Friends Day. I think you can all figure out what that one is. National Ups-a-Daisy Day. Wasn't exactly sure what that is, but National Ups-a-Daisy Day is set aside to encourage you to face the day positively and get up gloriously, gratefully, and gleefully each morning. So, for those of you that this is your first cup of coffee, well, ups-a-daisy. And last but not least, it is National Pick Your Poison Day. Historically, I thought the correct answer was bourbon, or whiskey in general, but I'm more of a bourbon guy. But after this weekend and trying to put up a pool for my kids, I have decided that pool water is my poison. So there you go. With that, I'm going to hand it over to my good friend, Jason. Jason's going to talk about loan rescue. And we have done a number of cases within what was formerly ISG and now E4IS on loan rescue. I bet you your clients have policies out there with loans, and it is a ticking time bomb waiting to happen that they're unaware of. If you can do some policy review, I bet you will find some. So with that lead in, Jason, it is all you.
All right, well, thank you very much, everybody, for joining us here on Monday morning. I am going to do our little screen share. Oops, says it's disabled.
I think I got you now. Sorry about that.
It's okay, there we go. All right, so can you see my screen?
We cannot.
You cannot. All right, let's try this again. Says we're good now.
Yes, we are.
There we go. Okay. So as Brendan mentioned, my name is Jason Jafferis. I'm a Regional Vice President here with Prudential based out of Madison, Wisconsin. The topic today is mirrored loans. It's a topic we have talked about as a company for roughly 4 or 5 years now. I think it's a prevalent topic given the situations that exist in our marketplace today, and I'll share with you a few ideas that I have with regard to this. But to get things started, I'm going to kind of walk you through what mirrored loans are, kind of the historical perspective of it, a simple case design, case sample to kind of walk you through the dynamics, and then again, the reason I feel this opportunity is prevalent in today's marketplace. So I'll get started here. Mirrored loans, basically we find these opportunities while we're conducting policy reviews. Clients' coverage needs change periodically, and so obviously there's an opportunity to dive into what do you have, how has it performed, is there any other alternatives that might be a better solution for you right now, given your needs, given the performance of the product, etc. So while policy reviews are an active part of what we do day in and day out, loan rescues or loans on policies are something we run into from time to time. And we're starting to see loans pop up on these policy reviews more now than we ever have historically. So my agenda today, and I'm going to run through this quickly, I want to be cognizant of your time. I'm going to give you the quick historical perspective, I'm going to give you a case study, and then I'm going to show you why Prudential has a great solution for this. Okay, so from a historical perspective, we started this process by actually looking internally at all the policies that Prudential had on the books that had loans. We actually had issues in our billing department when clients were attempting to pay loan balances and it was getting designated as premium coming into our payment center. So we had to send a letter out to all of our policies that had loans on them with a new system of paying loan balance versus paying premium. And we sent that letter out to 187,000 clients. And it got us thinking, we haven't sold whole life since 1999. So it's been over 20 years since we've sold a whole life contract. And we have 187,000 clients that have loans on their policies. If a company sells whole life, how many policies do they have that have loans on their policies? So that was the birth of our idea of promoting and really building out a product portfolio that can help manage policies with loans. So there's two ways that policies end up on loans. The client either has a need for the money and takes and initiates a loan, or certain types of policies have what's called an automatic premium loan, where if dividend or interest is not sufficient to cover the premium due in that year, the company will automatically loan the premium. Doesn't notify the client necessarily, but they will automatically loan the premium and create a loan balance on that product. Whole life is really the prevalent area of finding these types of policies, and some of you might guess that whole life sales are down in today's world, and that more of the insurance is being sold either in the term, universal life, or variable marketplace, including indexed universal. But you'll see from this graph in 2018, whole life still made up over 35% of all life sales in the marketplace. So whole life is still being sold. It's been a prevalent product since its birth many years ago. However, the dividend scale over time has dropped significantly. So policies that were taken out in 1995 at an 8.5%, 9% dividend rate are now currently experiencing somewhere between a 5% and 6.5% dividend rate. That can have a big effect on that automatic premium loan that I talked about, where dividends were supposed to be sufficient enough to cover premium at a certain point in time in the future, and that dividend is no longer able to do that. So what are the long-term consequences? Number one, an unpaid loan is going to accumulate interest, which negatively impacts the policy. Interest leads to increased costs. That interest that accrues each year, if the client's paying it, is going to continue to be additional premium above and beyond what they're paying currently. And then if the policy gets far enough along that it lapses, the client faces a potential tax burden, which we often sometimes call phantom income. They may have never touched the loan ever, but because it lapsed with the loan on it, they now owe income tax on that loan amount. So at Prudential, we look at it, every policy that has a loan on it, under three different solutions. One, do nothing. What happens if we do nothing to this policy? Is it healthy enough to sustain the next 5 years, 10 years, 15 years? What's the loan interest rate on it? How can we project how this policy is going to perform if we do nothing? Number two, we pay off the loan or a portion of the loan or the loan interest with out-of-pocket funds. And we look at how that policy performs under that scenario. Does it put an unnecessary burden on the policyholder to add the interest to the premium they're already paying? Does it fit within their budget? How does this compare to option one with do nothing? And then option three, we 1035 the existing policy for a new policy, and we look for opportunities to lower the loan cost, lower the interest on the loan, or potentially use cost basis internally to just pay off the loan altogether. And that's kind of what we'll get into today with our case sample. So every policy that comes in our door, we look at these three options, and we try to help the client and the agent determine what's the best route to go. So for a case study, I'm going to actually switch over to an illustration that I've run recently. And in this particular one, we're using a variable policy. We use all sorts of fixed policies, indexed policies, et cetera. This particular case example just happened to be a policy with our variable product that has long-term guarantees. So in this particular case, this client is male, age 56. He's a non-smoker plus, which is our comparable standard to what other carriers have in the marketplace. He'd been paying on this policy for about 20 years, $5,000 a year for $500,000. He had $165,000 of cash value and $55,000 of loan. So a pretty typical case that we see in the loan rescue marketplace. Nothing too extreme where it's loaned out at 90%, but nothing minimal where you could probably take care of the loan with out-of-pocket expenses and not have to worry about this process. So this is the typical case that we see. And so what we do here is we actually 1035 over the loan and the net cash value. So you'll see here in year one, our total annual premium in year one is $167,589. 165 of that is the total gross cash value, the loan plus the net cash value, and the additional $25.89 is our first year annual premium. Okay, so remember, he was paying $5,000 on this policy annually and had a $55,000 loan. So after we 1035 and pay that first annual premium, you can see these columns over here. Our contract fund is $156,000. That's our cash value that's in the policy. Our surrender value is only $83,000 though, because we have that loan attached to it. And then our net death benefit, $600,000. In year two, column 2 here, we're still going to pay that $25.89 a premium, but we're going to take a withdrawal from our $100,000 of cost basis, and we're actually going to pay back the loan internally. Now you're able to do this with universal life, indexed universal life, variable universal life if you structure it correctly. This is a difficult task to do with many whole life contracts because of the guaranteed cash value features that are inside there. Oftentimes you can't touch that guaranteed cash value, so it makes paying loans back a little more difficult with whole life contracts. At the end of year two, we have, in essence, wiped out the loan. We have now provided $500,000 of net death benefit, and we've cut the premium in half. So we have $25.89 versus $5,000 that they were paying, $500,000 of death benefit. This little caret right here means that the policy has a no lapse guarantee provision. And if I scroll down, you'll see that no lapse guarantee provision goes all the way through age 84, roughly 30 years. But all along the way, too, we're also building cash value in the contract. So there's still additional value inside of this. If they needed to take a loan or take a withdrawal at some point for any other necessities that they face with their economic conditions. So again, this is kind of a typical case study that we run into. The ones that I have in here are ones that they're kind of the extreme, the two poles of what we see. The reason I bring that up about the cash value, though, is we're in an era right now, a part of our market where sometimes taking loans against the policy seems like an attractive opportunity right now. Just last week, we actually discussed the opportunity with one client of doing what we call an intentional loan rescue, where they were contemplating taking a loan out of the policy, but then wanted to look at what would happen to the policy long term. With that strategy, we can talk about taking loans out and then looking at future loan rescue a year down the line, 2 years down the line, even 6 months down the line if they choose to, but providing cash now when it's needed, which is what your life insurance cash value is for, but then knowing that there's a solution on the back end that can help you alleviate that loan, depending on that loan interest rate and how everything accrues over time. So then my third point that I wanted to get into was why Prudential? You know, what advantages do we have versus some of our competitors in the marketplace? Well, the first competitive part of it really has to do with our requirements. And I specifically mean number one here. Our minimum net cash surrender value has to be $25,000 for any policy. That's our only real requirement with regard to the loan. So some of our competitors have specific 60% loan to value or 50% loan to value thresholds where if the loan exceeds this threshold, they won't look at it. We have no thresholding at all. Really all we're looking at is if it has $25,000 of net cash value, we'll take a look at it and we'll do our best to find a solution that's going to work for the client. It does require a corporate exception. This is really part of our overall protocol. The reason we have this is a safety valve for the client just to ensure that when the loan comes over with the cash value, we don't want this policy in any danger of lapsing in the first few years and creating a taxable event. So our corporate exception team actually looks at every case individually to ensure that that doesn't happen. And then number 3, it does require full underwriting. Now in today's world, we also have the fluidless underwriting, the accelerated underwriting process. Loan rescues can fit within that guideline. Currently ours falls into the age 18 to 60 up to 3 million. That does not require an exam or APSs necessarily, unless we find that there's an underlying health condition. But it does require full underwriting. It is not a simplified issue type process. Other advantages that we have, significant advanced markets expertise. We've been in this marketplace, as I said, for 5 years, close to 5 years. We have a team of people that do nothing all day except for run loan rescue illustrations. On an average day, we probably run somewhere between 30 and 50 new loan rescue cases. Last year alone, our total placed new business premium in this marketplace specifically was $22 million. All products are available. So our second advantage is we don't limit you to one specific product. We actually have all of our products, all of our permanent products are available, variable, indexed, fixed, anything that is that fits the comfort level and the risk tolerance of the client. And then again, number 3, no strict loan to value percentage limitations. Another advantage that we have, and this is something you can work with E4 in learning about, is our policy management tool. This is available to any in-force policy. You have real-time access to the values inside that policy, the death benefit, cash value, loan balance, loan interest being charged. This gives you up-to-the-minute data at your fingertips and also allows you to run hypothetical situations. If a client's looking to maybe make a loan payment out of pocket, how does that affect the policy long term? This actually is a tool that you have access to through E4 to provide instant feedback to how that's going to look or how that's going to project. So this is kind of a first to market tool that we have. Our partnership with E4 allows access to that. If you're interested in learning more about that, please contact them. And then lastly, it's just a summary to kind of wind this up. You know, historical perspective. Again, we're seeing more and more of these cases now than we've ever seen before. Initially, when we rolled this concept out 5 years ago, we did about $2 million of new business premium. The following year, we did 5. The year after that, 10, then 17, then 22. And then this year, prior to everything that was happening with COVID, we were projecting about a $30 to $32 million marketplace in loan rescue. I've given you kind of the quick kind of day-to-day loan rescue case that we see. You'll probably see some of those in your book of business if you're asking about policy reviews. And then hopefully you've seen what the Prudential advantages are in terms of full product portfolio, aftermarket tools to use to help manage that business, and no strict loan to value scenarios that can preclude you from using us. I feel we have a strong market presence here. We have expertise that I think is unparalleled in the industry, and we know that these cases are out there. So with that in mind, while you're doing policy reviews, if you see the loan, if you see anything that looks like a loan, contact E4. I know they're going to help you identify what exactly it is and then pull all the pertinent information from that to help go through and do those 3 things. What happens if we do nothing? What happens if we make payments? What happens if we look at another carrier? And with that, I'll wind it back to you, Brendan. Thank you.
Awesome. Thank you, Jason. Just wanted to make 2 points. Often had the question, you know, why we're waiting to year 2 to take the loan. And that is because you need to make sure that it's not a step transaction or that there's considered boot taxable income. Also, if you're doing an intentional loan rescue, 6 months may be fine, but you may have to go out to a year depending on the carrier and how they're going to report that 1035 exchange. Again, is it going to be step transaction and boot. So with that, I will open it up for questions from the field. If you have questions, unmute yourself and go away or fire away.
Hey, Jason, Chase here.
Hey, Chase.
Brendan and I are working on a withdrawal actually right now for a client that did this. So with the paperwork that's required, will you guys just process the withdrawal internally, or what does that look like for the client?
Yeah, there's a specific form that we have when you're paying back the loan. It's part of our policy owner services team, where you'll specifically designate this as a withdrawal to pay back loan.
Okay.
And we have a process internally where we just have to designate exactly how you want that withdrawal credited back. Do you want it delivered to you where you're going to pay the loan yourself out of pocket, or do you want it all handled internally? If you need help with that form, you just send me an email later today. I can, John and I can pull up that form for you.
I think I will, because the other question, kind of follow up to that, is it worth looking at like an in-force illustration for performance over it, or is it still better to just kind of follow what the original illustrated intention was?
It's probably still better to follow the original illustrated intention, simply because if we're paying off the loan, it's going to have an immediate positive impact to the policy.
Okay.
Delaying that it may look the same, but it's not going to enhance it in any way. We definitely can, though. If you want to send me the policy number, I can have the team run scenarios where we look at maybe delaying it another year or two, so you can actually have that comparison to show your client.
Sure. Yeah, I'll send you an email on that.
Okay.
Thanks.
All right. Any other questions? All right. Well, I want to thank you all for being here. I want to thank Jason and Prudential. Everyone have a great week, and go get them.